Welcome back to SilverDispatch. I'm OG Peter, and what I'm about to walk you through is not a forecast. It is not optimism dressed in data. It is a structured reading of what the numbers are actually communicating right now. In this week, in this market, at this specific intersection of geopolitical stress and monetary uncertainty, that frankly, no financial model built before 2025 was ever designed to process. There is a moment, rare but recognizable to those trained to see it, when the instruments that the financial system treats as bedrock, the ones pension committees rely on, the ones that institutional asset managers are legally required to hold, begin moving in ways those same models say they should not. Not because the models are careless, but because they were built for a world that has quietly stopped existing. That moment is not approaching. It is already in motion. As of May 15, 2026, silver is trading at approximately $78 per ounce on the spot market. Pull back your view and let the full picture settle. Silver's 52-week trading range runs from $31.98 at its floor to an all-time nominal high of $121.67 reached on January 29th of this year. That is a range of nearly $90 within a single calendar year. Ask yourself, when was the last time a major financial asset nearly quadrupled and still sat inside what gets described as a normal trading environment? This is where it gets interesting. Silver pulled back sharply this week, roughly 6% in a single session, driven by a firming dollar and rising treasury yields. Every headline framed it as weakness. But the structural story that produced the move from $32 to $121 has not changed in a single meaningful way. Not one fracture is closed. Not one supply deficit has been resolved. The pullback is real. The interpretation being sold to you about what that pullback means is something else entirely. However, before we get into the anatomy of what is actually driving this market, I want to set something on the table that most financial channels will not say plainly. The bearish case deserves the same intellectual honesty as the constructive one. I will give it to you. Every piece of it. Because the investor who only receives the argument they came looking for is the investor the market eventually teaches the most expensive lesson. Stay with me. The data does not ask for your comfort. It asks only for your attention. And in the next section, I'm going to show you exactly what arrived in the economic data on May 13th that sent professional traders scrambling to reprice the entire rate outlook in under 90 minutes. On the morning of May 13th, 2026, the United States Bureau of Labor Statistics released the April Producer Price Index. The professional consensus, assembled by the most credentialed economists at the most capitalized institutions on the planet, was expecting a monthly increase of 0.4%. What arrived was 1.4%, 3.5 times the forecast. On an annualized basis, that translates to producer price growth of 6.0%, the hottest reading since December of 2022. But there is a catch, because that headline number is only the surface of the report. Core producer prices, the reading that strips out food and energy to isolate underlying pipeline pressure, rose 1.0% month-on-month against a consensus of 0.3%. Stage 1 intermediate demand, which represents input costs still working their way toward the consumer's wallet, rose 2.7% in a single month and 8.9% on a 12-month basis. That is the largest annual advance in that category since October of 2022. This came precisely one day after the April Consumer Price Index confirmed headline inflation, running at 3.8% year-on-year, the highest reading since May of 2023. Read both reports together, not separately. Inflation is not moderating at the wholesale level. The pipeline is repressurizing. So, what does a financial system that had priced in zero rate hikes for 2026 do when the data arrives 3 times hotter than expected? It reprices. Fast. Within 90 minutes of the 8:30 a.m., release federal funds futures, that vast, unsentimental mechanism of collective probability, doubled its implied odds of a Federal Reserve rate hike by December. 1 week prior, those odds sat at approximately 16%. By Wednesday afternoon, they had climbed above 30%. Zero rate cuts are now priced for the full calendar year. The 10-year Treasury yield sits at 4.49%, its highest level in 10 months. The 30-year has crossed 5%. Now here is what the conventional framework says should follow from that. Rising yields raise the opportunity cost of holding non-yielding assets like silver. A strengthening dollar makes dollar-denominated commodities more expensive to foreign buyers, compressing demand. By the standard model, silver should be in retreat, not just this week, but structurally. However, silver has risen more than 159% over the trailing 12 months, inside an environment where conventional models predicted it should be suffering. That divergence is not noise. It is signal, and in the next section, I'm going to show you the structural forces, the supply data, the COMEX coverage ratios, the sovereign accumulation patterns. that explain why the conventional framework is no longer the right lens for reading this market. Because what the models were built for and what this market is actually doing are two different things entirely. Let me show you where the structural picture begins to diverge from the narrative you are probably hearing elsewhere. The Silver Institute's World Silver Survey 2026, published April 15th, projects a supply deficit of 46.3 million ounces for the current year alone, the sixth consecutive annual shortfall. The cumulative drawdown of above-ground silver inventory since 2021 has reached 762.1 million ounces. The Institute used language that commodity surveys rarely carry. Silver has entered what it formally describes as an era of reduced stocks. COMEX registered silver, the category actually available for physical delivery against futures contracts, has declined from a peak of 531 million ounces in October 2025 to approximately 315 million ounces today. Earlier this year, it briefly fell below 100 million ounces for the first time on record. There are currently roughly 7 paper claims for every single deliverable ounce sitting in the registered system. Does that sound like a market running with comfortable inventory cushions? Now add the geopolitical layer. The Strait of Hormuz, through which roughly 20% of global oil supply normally moves, has been effectively closed to commercial shipping for more than 70 days. West Texas Intermediate crude trades above $111 per barrel. Brent above $115. The International Energy Agency has stated directly that even a faster-than-expected resolution could leave the market severely undersupplied through October. The April PPI print was significantly energy-driven. That energy input has not been removed. It has persisted. However, the institutional story may be the most structurally significant piece of all. On May 13th, the United States Senate confirmed Kevin Warsh as the 11th chair of the modern Federal Reserve era by a vote of 54 to 45, the slimmest confirmation margin in the recorded history of the institution. During his prior governorship, Warsh argued publicly that the Fed's balance sheet expansion had overreached. He has, in his own published words, called for what he termed regime change at the central bank. He inherits the chairmanship with the hottest combined inflation environment in nearly 4 years. His first FOMC meeting is scheduled for June 16th and 17th. Jerome Powell will remain on the Board of Governors through January 2028, the first departing chair to return to the board in nearly 8 decades. The modern Federal Reserve has never operated under this kind of structural ambiguity. Markets price ambiguity harshly. Silver historically has performed well within it, and in Beijing this week, President Trump concluded the first American presidential state visit to China in nearly 9 years. China arrived at that table holding leverage across rare earth exports, physical silver inventory, semiconductor access, and Iranian mediation. Chinese buyers are currently paying premiums of 12 to 13% above Western spot prices. That premium is not an anomaly. It is a market communicating that available supply is inadequate relative to stated demand at current prices. In the final section, I will tell you exactly what all of this means for how you should be thinking about this moment. Here's the discipline this analysis owes you before we close. The bearish case is real, and it deserves honest presentation. Silver at $78 on May 15th remains approximately 36% below its all-time intraday high of $121.67. Treasury yields at 4.49% on the 10-year and above 5% on the 30-year represent genuine compounding opportunity costs against a zero-yield metal in an environment where rate cuts have been effectively taken off the table. The dollar firmed into the PPI release and has continued strengthening, creating direct downward pressure on dollar-denominated commodities. There is also this. Bloomberg NEF projects 2026 photovoltaic silver demand at approximately 194 million ounces, a roughly 7% year-on-year decline, as solar manufacturers continue reducing silver content per panel through metallization efficiency improvements. The iShares Silver Trust shows 3-month net outflows of approximately $2.8 billion, a figure materially larger than this week's 5-day inflow. These are not footnotes. They are genuine headwinds that belong in any honest accounting. However, Bank of America's published upper bound 2026 silver price target sits at approximately $30 per ounce, a figure that, as of even today's depressed session, sits roughly 100% below where silver is actually trading. A major investment bank's ceiling forecast for this metal is 2 times below where it trades on its worst session of the month. That is not evidence that silver is overpriced. It is evidence that the models built before the Hormuz closure, before the hawkish Fed chair confirmation, before 6 consecutive years of supply deficits, are producing answers that belong to a world that no longer exists. The Sprott Physical Silver Trust's most recent 10Q shows holdings of 216.88 million ounces of fully allocated London good delivery silver up from 210.7 million at year-end 2024, a net addition of 6.1 million ounces in Q1 alone. Russia has incorporated silver into its sovereign precious metals reserve program. Central banks purchased a net 244 metric tons of gold in Q1 2026, the fastest accumulation pace in over a year, even as gold prices reached a record $5,405 per ounce at their recent peak. The sovereign accumulation story is not a rumor. It is in the filed records. So here's where I leave you, and I want to be precise about this. As of the close of the trading week on May 15, 2026, every structural fracture documented across these four sections remains open. The Hormuz Strait is still effectively closed. The supply deficit for 2026 does not shrink because silver sold off 6% in a single Friday session. The cumulative 762 million ounce drawdown does not reverse because a stronger dollar generated liquidation pressure. The new Fed chair still walks into his first FOMC meeting in June, carrying the hottest inflation environment in 4 years. The market has never once rewarded the investor who chose the story that felt better over the story the numbers were actually telling. I'm OG Peter. This is SilverDispatch. Drop a comment below. Tell me which of these fractures concerns you most, or where you think this analysis missed something important. And remember, everything here is for education and discussion only, not personal financial advice. You make your own decisions with your own money and your own risk tolerance. I'll see you in the next one.